Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Tuesday, 29th July. Coming up on the show, well, after a trade deal was reached between the EU and the US, markets take a reality check on what tariffs will actually mean. We'll give you details of a stock that jumped yesterday and has skyrocketed overnight. And I've been speaking to the boss of a Chinese EV maker that's taking on Europe's biggest luxury car brands. But first, an update on the mass shooting in New York City. 4 people were killed in a midtown Manhattan office building after an armed gunman opened fire in the corporate high-rise at roughly 6:30 p.m. Eastern. The building is the headquarters of the NFL and private equity giant Blackstone and several other financial firms. The suspected gunman was identified by police as Shane Tamura, a 27-year-old Las Vegas resident with a history of mental illness. He died from a self-inflicted gunshot wound, officials said. Of the 4 victims, one was a New York City police officer and another reportedly an executive at Blackstone. We'll be following the story all day here at Yahoo Finance and we'll bring you updates as they come in. OK, let's kick off the things you need to know before the opening bell rings by looking at the futures markets. US stock futures are edging higher as Wall Street readies itself for more fresh earnings. Turning to European indices now, and well, it's a sea of green. Why? Well, there's been some pretty impressive corporate results out this morning, including AstraZeneca and Barclays. AstraZeneca helped boost the FTSE 100 after the pharma giant reported a 26% rise in pre-tax profits for the first half of 2025. Barclays also reported impressive results, and the bank reported better than expected profits and announced a $1.33 billion share buyback. And finally, a quick look at Asian markets. Here it was a bit more of a mixed picture. Perhaps the reality that tariffs are here to stay is really kicking in. And also remember, we saw a spike in oil prices on Monday after President Trump threatened a new deadline of 10 or 12 days for Russia to make progress towards ending the war in Ukraine or face tougher sanctions on oil exports. Now, the next thing you need to know before the opening bell rings is also focused on tariffs. The car giant Stellantis put out a pretty stark warning about how much they'll cost its business. $1.7 billion this year alone. That's 5 times the hit taken in the first 6 months of the year, when the car maker tallied losses of $2.65 billion. President Trump's tariffs cost the company responsible for brands like Chrysler, Dodge and Jeep $346 million for the first half of the year. During that period, US shipments were down by nearly a quarter as the car maker reduced the importation of vehicles produced from abroad. And now the final thing you need to know before that bell rings is that US and Chinese officials are continuing their trade negotiations in Stockholm this week. In fact, Treasury Secretary Scott Bessent has arrived today in Sweden for talks. Now remember, the deadline for China is not August the 1st, but August 12th. And yesterday we brought you reports that the deadline could be extended by 3 months. The talks are being closely watched for whether they move the countries towards a face-to-face later this year between Presidents Trump and Xi, something Donald Trump said on Truth Social today that he wasn't that bothered by. The talks with China are thought to be more complex than with other nations, and talks are still ongoing with other countries as well, including South Korea and Canada. Now, tariffs are bound to hit the US consumer, and one sector which is highly reliant on China is the toy sector. Jay Foreman, CEO of Basic Fun, gave his reaction to the latest tariff news to my colleague Julie Hyman on Market Catalysts.
We stand a lot better than we were at 145% on Liberation Day, but 30% is, no real consolation. I remember when it was first announced at 10, we were all losing our minds and we knew that 10 was a lot. Today, I guess we'd probably be pretty happy at 10. We're also in our industry hoping maybe for an exemption for toys, given how special this category is and how difficult it is to manufacture here in the States. But we're doing our best. I mean, manufacturers in toys and other import segments and categories kind of been eating it a bit, passing a bit of it along to the retailers, and the retailers have been passing it a bit along to the consumer. You're not seeing it a lot now. But as we get into the late third quarter and fourth quarter, you will start to see it more. And certainly as we get into 2026, the tariffs will become a cost of doing business and a built-in cost in the product. So it's going to be a trickle effect of increased prices to the consumer and lower profits to manufacturers. It's, in some ways, somewhat of a transfer of wealth.
We're showing the Care Bear video, and I'm feeling very nostalgic, Jay. So of that 30%, how much for you guys do you anticipate getting passed on?
So I would say of the 30, about 20 is going to get passed on. And the question is, will the retailers absorb some or all of it, or will it get passed along to the consumer? Again, this year's a little tricky because everybody's not been sure of where it's going to end up. So a lot more has been absorbed so far than will in the future. So I would anticipate probably 10 being absorbed by the importer, 10 being absorbed by the retailer, and 10 being passed along this year. But the fact is, as we get into 2026 and brand new items become created, those items will be designed, marketed, and sold with the tariffs built in. So there will be a reckoning. We can already see it with automobiles. It's very hard to absorb 15 or 25% tariffs plus on steel and aluminum and not be infected and all the things that are coming back across the borders between Mexico and the U.S. You're going to start to see it in cars probably more than anywhere else soon, but you'll see it in consumer products very quickly. Nobody has the kind of margins to absorb 30%. We're hoping it gets a little bit lower as these trade negotiations go on the next few days and weeks,
right,
with China in particular.
And Jay, talk to me now about the demand side, right? What have you guys been seeing there? Because there's been a lot of concern this year, especially that lower income consumers were not, that their spending power was waning a little bit. Are you seeing that in your business yet?
For sure. I mean, we are seeing a strain on the lower income consumers. Some of them aren't shopping because there are a lot of low-end consumers that shop in value stores that are immigrants, and they're worried about going out and shopping and sort of being seen. We're seeing some tension on their spending and wallets. People are holding back. But in toys tends to be somewhat of a recession-proof category where people are going to spend on their kids. I will say there'll be a bit of a shortage on the shelves for a period of time because we didn't ship for about 6-8 weeks. And there's a lag. The inventory that came in the first part of the year is selling down and selling through. Probably see a lot of empty spaces and slots on shelves right now. The retailers are struggling to really understand the tariffs and how to work the pricing, but also struggling to reinstate orders for the rest of the season. So it's going to be a really funky year this year. As always, we would suggest the toys you think your kids really want and they tell you they really want, you should get sooner than later. It's going to be a very strange Christmas season this year.
Yeah, one of the other things I was reading that you and some of your peers in the industry are doing is sort of maybe shipping stuff without batteries, for example, trying to look for some creative solutions, I guess, to bring down cost. What other things are you guys looking at?
Yeah, we call it sort of deconstructing or the deconstruction option. So we'll create a toy. It could be a Tonka truck with lights and sound in a beautiful display box. And we'll offer it to our customers several different ways. One way might be without the battery so the consumer can purchase the batteries themselves. One might be with a sort of more simplified package or no package. And these are things that sort of take some value out of the toy, but they help to keep the price at a more reasonable level. But in the end, it still is a sort of a somewhat of a tax or cost to consumers, because if you don't get the battery in the toy, and I can buy the batteries cheaper than a consumer can at retail, you might spend $5, $6, $7 to buy the batteries to put in a toy instead of having them included in a package. Try to wrap a teddy bear or a Tonka truck that doesn't have a package. It's kind of funky and it'll be, a bit of a strange shape. So sometimes that package is also part of the whole joy and presentation of the product when a child gets it as a birthday present or a Christmas gift. But we're offering the options to our partners to deconstruct a little bit, take some value out, which would sort of mitigate a little bit of the cost of the tariffs. The one advantage that the consumer has over the manufacturer is the consumer has an unlimited amount of choices, whether it's in cars, price points in cars, features in cars, whether it's in toys. You can buy a $10 plush, a $20 plush, a $30 plush, the same thing with a car or a truck. Manufacturers have limited lines. We can't just change our lines overnight and make things overnight. So we're kind of stuck with selling what we've created months, if not years ago, tooling, designs. The consumer has a lot of options. If they want to spend less or get less value, they can exercise their choice, whether it's online or in the stores.
Okay, for market movers, we're going to be focusing on earnings that have just been released. We've got a slew of them. We start with United Health. These are really important numbers for the new boss who's just taken the role back after about 2.5 months ago, and he really needed to regain investor confidence. But its Q2 adjusted earnings per share have missed estimates, a reading there of $4.08 against a forecast of $4.59. Revenues of $116 billion just beat the street, but the company has issued fresh guidance below Wall Street estimates. The company said that adjusted earnings would be at least $16 a share in 2025. That's lower than the $20.40 average estimates from analysts in a Bloomberg survey. Now, back in April, the company had forecast adjusted earnings of $26 to $26.50 a share. Okay, let's move on to Spotify. Revenues came in below forecast. Q2 revenue came in at 4.19 billion euros against a forecast for 4.27 billion euros. And the company reckons that Q3 revenue will be 4.2 billion euros. That's below estimate as well. And as a result, you can see shares slumped in pre-market. They're down 5% in pre-market. At one point, they were down around 10%. Okay, next up on deck, we have UPS, United Parcel Services. It reported a decline in second quarter profit and revenue today as demand took a hit from the new de minimis tariffs on low-value Chinese shipments and mounting risks from President Donald Trump's trade policies. It reported adjusted earnings per share for the second quarter that missed the average analyst estimate as well. $1.55 was the number there against an estimate of $1.56. And shares down 4% in pre-market. Now, moving on to PayPal, and there we have a beat. So earnings per share came in at $1.40 against a $1.30 estimate, and revenue beat estimates as well, came in at $1.64 billion against $1.5 billion estimate. But shares there are also down in pre-market, down over 4%. Moving on now to Procter & Gamble. There, as earnings per share came in slightly above estimate at $1.48 against $1.42, and shares there are just slightly nudging up in the pre-market. Okay, Merck has also reported it narrowed its full-year sales forecast and plans to cut jobs. It's slashing $3 billion from its annual spending as it braces itself for off-brand competition for its cancer drug, Keytruda, which is actually the best-selling medicine in the world. Okay, and finally, we move on to SoFi, and their revenue came in slightly better than expected at $858 million against an estimate of $805 million. And look at the pre-market, up over 5% in pre-market. So investors pretty pleased there with the results from SoFi. Okay, it's time for a quick break. But when we're back, we'll hear from a CEO of a Chinese car company that wants to take on German giants. Welcome back to Market Sunrise. Now think about this. What if you could get a car that looks and feels just like a Porsche, but at the fraction of the price? That's what Zeekr, a Chinese EV company, is promising in an increasingly competitive EV market. This relatively new player wants to take on the likes of BMW, Mercedes, and even Tesla. Right now, it's pushing through a big expansion plan in Europe, where Tesla has been losing market share. So I sat down with the CEO for Europe, Lothar Schuppert, here in London to understand his strategy. So Lothar, you just recently released a survey about the view of European consumers on EVs and in particular Chinese brands. What did that survey tell us?
Yeah, I think it's a very interesting survey and a lot of learnings for us also, because you see the mindset in Europe is shifting, and it's shifting really from a traditional, conventional ICE mindset to a EV mindset first. So Every second of the participant has said, my next car will be an EV. So they're really looking into that, or they could imagine. And the second part of the survey was that, which is really interesting, that a big part can imagine, much more than before, that they are now looking for a Chinese car on their shopping list. And that is also what we see now actually going on in the market. The first half of the year was 1 million car sales on the electric side, the first time ever, with a share of 5% of Chinese manufacturers. So good learning where we see, and that's what we see every day also with our consumers, the shift is happening.
But how does your brand stand out against even the Chinese brands? I mean, the likes of SAIC's MG, for example, and BYD, they're ahead of you right now, aren't they?
Yeah, we are the youngest brand, or one of the youngest brands in Europe. We just recently launched, and we are live in the markets which have the highest adoption rate, like in the Nordics, Norway, Sweden, Denmark, and a few other smaller markets. We are now just ahead of the market launches for the bigger markets. But what is very unique for us, we are tackling the premium, the upper premium segment, even up to luxury. And that is where we as a brand and company also now investing a lot in creating that awareness. And we have been investing in R&D in Sweden, in Gothenburg, as a technology center for Zeekr. We have the global design in Sweden. So the cars are designed out of Europe for the world. So all these investments and commitments for Europe are clearly important to grow further with our experience, with the knowledge, and with the right products.
What about artificial intelligence? How much of a role is that playing in your process at the moment?
So artificial intelligence has two perspectives. One is in the development process, where we have just recently established in China an innovation center which is exclusively only looking into development of artificial intelligence and using that in R&D process, design processes, analytics, data crunching, and so on. And on the other hand, that is a growing field in the user field. So you have already geolocation services, of course, concierge service in the car where the car is talking to you. All these things are really important on the connectivity side. Plus, when you look about automated driving assistance, that is also a field where it is implemented and where we are also being benchmark in the industry.
But if I were to get into a Zeekr car right now, what would be the gadget that would impress me the most, do you think?
I think what everyone is impressed of is the package as a whole, because...
But you're not going to nail down one particular...
I will do, because the package in total makes the importance, because we have to get rid of the anxieties. The consumers are still really afraid about range, about charging speed, and so on. That's why I can say, and that's one of the biggest purchase reasons, the charging speed of our car. 800 volt, and so fast that you come back from your coffee, your car's already charged.
Okay, now you've already mentioned that you're looking for that luxury sector, but isn't it fair to say some of the legacy brands, the likes of BMW and Mercedes, for example, are getting more and more nimble? And how can you imagine to compete against these sort of powerhouses in Europe?
I mean, I spent 23 years for a traditional German car manufacturer, and I know quite well what the situation and what the challenges are in these companies.
And they've made changes too recently, BMW, with what their brand, what they're bringing out now as well.
Absolutely, and we don't deny they have a big strength in terms of heritage and awareness. But what also our survey showed is that especially the younger consumers, they don't look anymore so much into that. They are looking now for technology, for the leaps of what are the really product statements that they are in class, making it special. And that's where we believe we also have a point. We think that with Zeekr as an example, the manufacturers from China will have the approach of removing all the anxieties much more faster.
So do you believe that you'll bring a sort of German expertise to a Chinese EV maker then?
I think that is a big asset which is needed, because the European market is much more different than in China. And we feel, of course, with every discussion, every talk, every alignment we have in China, that they are keen to learn. So it's a strong collaboration with a learning curve where my experience and expertise is bringing a lot in. On the other hand, what I learned during my last 2.5 years from them is speed, agility, time to market, how they develop cars in such a speed on that level. That is really unbelievable. And I think that we as Zeekr, looking at our product life cycle from development side, is really outstanding.
So how quickly do you think you can really compete against these guys?
So when you look into the model 001, which is our luxury shooting brake, you see that we have life cycle time frames, sometimes only 18 to 24 months, and then the new model is launched. And there is incorporated a lot of changes in terms of software, a lot of changes in terms of hardware also, where I remember from my old times a much, much longer cycle behind.
And we'll see if consumers will buy into the Zeekr sales pitch. So far, the company has certainly had to face some unexpected challenges. We'll talk more about that in the second part of my interview with their CEO, airing tomorrow. Stay with us on Yahoo Finance. We'll look at some stocks that are going strong today, just after a short break. Welcome back to Market Sunrise. Time for our trading tickers today, and we start with a small but very active stock, Sarepta Therapeutics. Shares jumped nearly 50% in after-hours trading and are up a staggering just shy of 40% now. That's after the beleaguered drug maker said it would resume shipping of its gene therapy for some patients. The Food and Drug Administration had previously requested pausing shipments following the deaths of 2 teenagers who were taking the therapy. The FDA also said the recently reported death of an 8-year-old boy was unrelated to the Sarepta drugs he was taking. The stock jump is the latest in a series of drastic movements triggered by the company's changing fortunes. The FDA decision now significantly improves the sales of Sarepta's gene therapy known as LVDs. Okay, now here's another stock you need to know about today. Philips. It's up nearly 10% today as the company released earnings and said the impact of the trade war wasn't as severe as it feared. The Dutch maker of MRI and ultrasound medical devices increased its profitability outlook and now expects full-year operating margin of as much as 11.8%, a 50 basis point increase from its previous outlook. Philips shares are still much lower than a year ago, but investors are now more optimistic. The company's sales increased by 0.5% to nearly $5 billion, while analysts surveyed by Bloomberg expected a contraction. And finally, here's a Japanese stock that stands out today. Let's take a quick look at Nomura. As you can see, its share price has jumped around 4%. That's not a surprise when you look at the numbers that the investment brokerage firm just released. Okay, well, that's all the time we've got for Market Sunrise. Stay tuned to Yahoo Finance for more amazing analysis. I'm Ramzan Karmali. Go own the morning.